Well, good afternoon. Happy Friday, September 2nd. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Boy, the pain just doesn't let up for mortgage interest rates. The trend all throughout the month of August was just this slow deterioration in the value of mortgage-backed securities, which means interest rates were on this higher trajectory for the entire month. We were hoping to see a bounce back at the end of August, like we saw at the end of July, like we saw at the end of June. That did not play itself out, and now we enter into September with a little bit more of the same happening. I'll flip the screen around here and show you exactly what I'm talking about. So this is a chart of the last 30 days worth of mortgage-backed securities, and you can see this slow sell-off in mortgage-backed securities equaling higher interest rates. We're getting a little bit of a reprieve today as we head into the holiday weekend, but that is hardly enough to recapture the ground that has been lost over the past 30 days. If you look back at the past 3 months, you can see we were bouncing back and forth between these levels, but now we're getting back down to the worst levels of the year, things we experienced in mid-June. Now, one of the interesting things to note here is that we were all hoping for some improvement in interest rates when we got inflation data that told us that perhaps inflation peak was behind us and we were starting to moderate. Well, we've gotten that data. That's been the good news. The data has come in. The past 2 or 3 inflation reports, whether it's the CPI or the PCE, even unemployment, which was announced today, have all gone in our favor to help support the notion that maybe, just maybe, the worst of this inflation crisis is behind us. So why are we continuing to sell off? Why are things continuing to get worse? And you only need to look back 1 week from today at the Fed's speech at the Jackson Hole Symposium to get an indication as to why. And if you go back and check that speech or read any articles, you can hear a very hawkish tone from the Fed chairman reflecting that they're going to keep their foot on the gas in terms of rate increases to make sure that inflation, no matter how persistent it is eventually crushed. And the Fed even went so far as to use the phrase that there is going to be some pain on the horizon for the American consumer. And one can only think that means higher interest rates, higher unemployment, essentially forcing the economy into a recession in order to get inflation under control. And for those of you that have a little bit of gray hair on you, that might sound awfully familiar to some verbiage not heard since a Fed chairman by the name of Paul Volcker. Paul Volcker, who was appointed the Fed chairman by Jimmy Carter, had to do exactly the same thing back in the late 70s, early 80s, when inflation was this persistent problem baked in by, guess what, too much government spending, too much money in circulation, among other things. Now, this is where we get into the really interesting point about what's happening with interest rates. Because while there's certainly been some narrative about supply chain disruptions, we're all familiar with that, and while there's certainly been some narrative about the war in the Ukraine, really the juice here, what is forcing this record high inflation, or at least inflation that we haven't seen for the past 50 years, is the fact that we have too much money in circulation. During the pandemic, over the past 2.5 years, the federal government injected over $5 trillion worth of currency into the United States. And we can see that very clearly if we take a look at a quick graph here. I want to show you this graph, not to bore you to death with graphs, but let's take a look at this. This is M2. M2 represents all depository accounts and some timed deposits, like certificate of deposits, for instance. It represents all of those. And you can see from back here in the 1960s how we were trending in terms of all of the currency floating around out there in the United States. We get here to 2010 and we see this trajectory, and then here we are, if we can zoom into this, here we are in 2020 at the beginning of the pandemic, and we see this skyrocketing of M2, the amount of currency as measured in billions of dollars, the line almost going directly vertically up, and then here we are right there at April of 2022 into summer of 2022 at the highest level we've ever witnessed in the history of the country. Now, let's take a look at one more chart. I'm going to add one more line to this, and what we're going to add here is M1 in the United States, right? And M1 takes out those timed deposits, and it just shows you checking account, savings account, money market accounts. And take a look at the red line here for M1, and you can see what percentage of this increase is just cash in the pockets of Americans, and it skyrocketed here in 2020 and reaching pretty unfathomable levels. And when you have this much of anything, we all know this, right? When you have this much of any good out there, whether it's cash or cars or whatever, the value of it, of course, is going to be diminished. The more you have of something, the less you can command in terms of a value for it. So all of this cash in our pockets represents a devaluing of the currency. And when you have a devaluing of the currency, of course you're going to have record inflation. And this is going to take a long time to undo. And it's why the Fed is talking about near-term pain for the economy. What the Fed needs to do is drive up interest rates to a point that it begins hurting the consumer so much that they stop spending money, and maybe even drive unemployment up to the point where people start losing their jobs and taking money out of circulation. In the short run, that just means rates are going to continue to go up, and we can anticipate, and we should anticipate, interest rates will continue to increase, likely upwards of 6 to 6.5%, maybe even by the end of September. Of course, that's not welcome news, but it is the news and it is the truth, and it's something we have to be aware of, not only as citizens, but also as potential home buyers or home refinancers. If I can be of any service to you or help in any way possible, don't hesitate to reach out, mark.milam@highlandmtg.com. Thanks.